Hi, everybody. Bo Yoder here, and with me on the phone is Roger Corey, the developer of what we call the 3D Apex trading methodology, which is the engine behind the concept that we're going to introduce to you today, something we call predictive failure technology. So before we begin, let's just go ahead and look here. I just Googled what is today's date. You can see it's Monday, December the 1st, 2014. And December is important because it really is the reason why we've decided to make this a challenge month for us here at 3D Apex Trading. Now, December and August are traditionally the two worst months for trading. In August, people are on vacation, it's hot, a lot of folks in Europe are also off. You get a lot of liquidity drops and strange market action. Very similarly, in December, people are away for the holidays, they're traveling, people are coming to the end of their year. There's just a lot of forces that tend to make this a really terrible month. So we want to take that on as a challenge. We have an extremely accurate and consistent way to measure and analyze the market's movements and thus know when a trade is very likely to succeed, or more importantly, as we'll talk about today, when it's likely to fail. So if we can trade effectively in the worst month in the year, wouldn't that be a great test of our approach to the markets? So that's what brings us here today. What we're going to do is spend time trading the markets live Tuesdays, Wednesdays, and Thursdays for the month of December. We're going to do 11 sessions, so we get a good solid sample size. And our goal is to really show through because this is a doing skill, we want to do things in a live environment. We're going to record that and make that available to really show you what is possible no matter what market conditions are available. There's always opportunity someplace if you just know where to look. So with that little preamble, let's go ahead and bring Roger in and talk a little bit about the reason we're all here, which is making money in the financial markets.
Hi, everybody. Thank you, Bo, for that intro. One of the quick questions that I think is going to be on someone's mind is going to be, what markets is this applicable for? And really, we're going to be focusing throughout the month of December specifically on the S&P, but it is applicable in any market you are interested in, whether it's commodities, whether it's in the stock market, any particular symbol, any index, even bonds.
And the reason for that is what we're doing here, and you're going to see some real life examples here in a moment. We're measuring odds, and the odds are always there in any market. It's just a matter of determining what the odds are for any given setup or scenario.
Because what's important here isn't what opportunities are available in the market. What's important is how likely are those opportunities going to work out for you versus just jumping in at anything that looks good, that meets some specific strategy that you might have in place, whatever objectives you have, and you're looking for particular opportunities in the market that set up and look a certain way, whether it's seasonal, whether it's based on something fundamental, whether it's based on market sentiment, whether it's through technicals. It really doesn't matter. What you'll see actually is that the 3D Apex predictive failure technology incorporates all of that into its analysis and filtration structure. So now one of the biggest reasons we participate in the market is because we want to make money. However, the focus will greatly either enhance or hinder your actual outcome. And we're going to talk about that today, and we're going to kind of set the stage for how we evolve over the coming days in the month of December.
I think everyone's heard and is familiar with the concept of contrarian investing, right? When everybody's very fearful, that may be a time to buy. When everybody's very excited about the markets, that might be a time to sell. And that really leads sort of to the next point, which is markets are very counterintuitive. They often reward what doesn't necessarily seem like the logical move. And having an analysis structure that allows you to objectively measure the market conditions and therefore really see the data that is underlying the move helps you to not get lost in a lot of those very traditional trading traps. One of the biggest ones is the misconception that people have to catch some kind of a big move in order to make big money. And with that comes the fear of missing a move, which ironically tends to be more scary to people than actually losing their hard-earned capital.
And that's an interesting concept because there's a deception there in making money. It's an upside down focus and it really hinders your potential. When you're so focused on making money, you inherently develop a little bit of a tunnel vision, a very narrow perspective of the market. And what that does is it blinds you naturally from the forces that are literally hidden in plain sight otherwise, that would warn or alert you that this is not likely a profitable entry, right? And so what you get is someone who maybe is focused on passing through an intersection before the light turns red. The problem with that is if they're so narrowly focused on getting through that intersection before it turns red, and they're coming just at the tail end of that, well, on the other side, it could be maybe another vehicle that is coming and notices the light went from green to yellow and is about to go red for where you're at. And they're assuming that if they just kind of keep a certain pace, a certain speed, they wouldn't have to stop, and they can go right through their intersection just as it turns green. Well, you can notice how both of you are focused on the wrong things because you miss each other entirely, and both of you go through the intersection at the wrong exact time, and you get hit, and you have a car accident. So this focus on money, though it's logical, is actually not the best focus to have. So we're going to have you shift your focus a bit from opportunities in the market that are likely to make you money to instead focus on opportunities in the market that are not likely to lose you any money. All of those opportunities will look different from that perspective. So what is the actual benefit of that to you? For most individuals that are active in the markets, especially those that are very, very active, where they are in and out of the markets in a shorter time frame, whether that be a day trader, a swing trader, position trader, as well as longer term traders who enter and exit the market maybe on monthly or yearly cycles, depending on their objectives. It really doesn't matter. But what's important to understand is when you come into the market at the least efficient time, where the market's not set up where the highest odds are strongly in your favor, you end up entering the market and then holding onto positions that end up working against you or really don't go anywhere, and you've tied up that capital, and that capital cannot be redeployed more efficiently or effectively to go earn money for you. And so what happens is you're also holding on to the stress and the uncertainty of when and where the market's going to move. You guess at what the best entry would be, and then you hope it works out. And it's a very inefficient way to interact with the market and to try to make money. Now, let's look at a principle in life that few ever really harness or even know how to implement. And it's the principle of less is more. Now, that's easy to say, but the reason most people don't or can't follow this principle is because it's tricky to actually implement with any consistency and confidence until now, of course, with what we're going to share with you through the 3D Apex predictive failure technology. As an example, in the financial markets, that contrarian point of view that Bo mentioned is very well established, but again, it's not so easily executed. Before getting into this, let's point out another important principle. And it's not about how much money you can make in the market, but it's how much you can keep, right? So if you can avoid the opportunities that cost you or lose you money, then by definition, the winning opportunities have a real chance to make the bigger impact on your bottom line and with a lot less stress, effort, and time. So to sum all this up, the old adage of manage your money wisely is what everyone hopes for and hopefully tries to do in order to achieve their financial goals, and that's where everyone has predominantly been taught to focus. Yet it's fundamentally the weakest and least impactful position to take when you're after something meaningful, something that's truly life transforming in terms of your financial goals, that's going to allow you to really gain the kind of freedom and confident level of security that you really desire in your life in regards to your ability to make and grow, but more importantly, keep your money. So, wisely managing your risk is what should be the focus, right? Managing risk, not managing money. And although it sounds like it's something you may think you do right now, there is a shift in focus and context that will give you a radically different perspective, which will create a dramatically different and rather pleasantly surprising outcome. So having said all that, what if you never needed to worry about catching or missing the next big move? What if you didn't need to look for opportunities that make you money? What if instead you shifted your focus to opportunities that were not likely to lose you money? You see, everything is going to change for you when you start looking at the market and the inherent opportunities that are available to you from that perspective. Because now all of a sudden, you've taken yourself out of the gambling mentality, And no matter how educated you are about a particular strategy, a technique, fundamentals, etc., which really still has you largely guessing based on statistical research at what you should do, though it's an educated guess, but you're still hoping it will work out, and you don't really know with any real confidence what is likely going to occur until after the fact. That's not really fun, and in fact, it's pretty stressful. So, with the shift in perspective, you're now suddenly operating no longer like a gambler who's making chance profits regardless of how proficient of a gambler they are, but more like the casino who makes very deliberate profits and has set the environment up to work in their favor because they control the odds in which they're willing to engage. Ever heard that casino is the house and the house always wins because the odds are purposely set in their favor? Well, now for the first time in the investment and trading industry of the financial markets, you'll be able to do just that with the innovative approach of the 3D Apex predictive failure technology. Now, for the first time, you'll be able to actually value and objectively measure when to invest or trade the odds. In other words, you'll be able to value which opportunity is worth the risk because not only is the reward worthwhile, but because the probability for a successful outcome is where the odds are at 80 to 90% in your favor. Now, many of you already know that a true investment scenario with a winning rate of 90% just doesn't exist in the markets long term. What our approach allows for you to do is to find scenarios in which, in a best case scenario, if the rest of the world experiences a 60% win rate and we just avoided the losses, the majority of those losses, our effective win rate then can suddenly jump into 88 to 94%. Remember, if we're able to actually identify 80 to 90% of the opportunities that are not likely to work out in your favor, having just a 60% winning edge in the market and avoiding that will end up giving you an effective win rate of 88 to 94%. Now, using the 3D Apex predictive failure technology, you'll be able to objectively measure and value which signal is likely false, where the odds are low that it will work out, and therefore you can avoid taking that signal, leaving you with mostly the winning ones. And from a mathematical point of view, that means if you can avoid 90% of the false signals that you'll end up losing money on, all right, which you'd have otherwise taken before now, then you're left with what? Just simply the 10% that couldn't somehow be filtered out for you. And remember, nothing's 100%, but we don't need it to be to accomplish our profit objectives in this scenario. And of course, you still have your winners. So what does this mean? Now, here's where less truly is more, because we're now focused on quality, not quantity. And we'll be interested in the effective win rate rather than simply be stuck with the statistical win rate. So let's see how this plays out visually. Bo, why don't we use an Excel spreadsheet here and we can go over that.
Yeah, okay, so it's very important to understand the concept of a statistical edge. A statistical edge is one based on often just lots and lots of hours of research, and it could be something as simple as researching over the last 20 years and finding out that the first Monday of every month is likely to be a big up day. It could be that the market tends to reverse around 2 o'clock. These are statistical edges. So let's assume that whatever the edge is, it has a 60% effectiveness rate or a win rate. And that means that essentially you're going to get 60 winners for every 100. Now, the sticking part with a statistical edge in the markets is that you don't know which 60 out of 100 are going to be the winners and which, therefore 40 are going to be the losers, right? So simple math, right? You take 100 trades, you have 60% win rate. You're going to expect to take somewhere around 60% of your trades home as winners and then 40% home as losers. You don't know before you take the trade which is which. That's a classic statistical edge, and really what 99.9% of all market participants engage in. They've got some statistical edge in the marketplace, and they're willing to lose a certain percentage out of every 100 trades in order to have a positive expectancy over time. Now, what we've done is take another layer of statistical analysis on top of a traditional statistical edge. So if we took that same trading strategy, that same idea, that same concept, and then overlaid predictive failure analysis, which will allow us to identify and avoid 80 to 90% of potential losses before you take them and get stuck, let's look at the math there. Same 100 trades taken, or same 100 trades offered by the market, you're still going to see the same number of winners. You can't manufacture more winners with a better strategy or a different strategy here. This predictive failure analysis is a layer of analysis which sits on top of your statistical edge. So you still have the same 60 winners, but look at what happens to your losers. If you're able to identify and avoid 80% of your losers, now you're only left with 8 losers. If you're able to identify and avoid 90% of your losers out of that 100 trade sample, now you're only left with 4 losers, which gives you an effective win rate. In other words, the win rate that you actually experience of 88 to 94%. But look at another thing that's happened here. There were 100 potential trades, but if you took the 60, obviously, that won, and the 4 or 8 that ended up losing, because again, there's nothing that's 100%, now you only took 68 trades out of 100. You're working less and you're making more. It's a win-win scenario.
You see how powerful that is? You see, the loss avoidance factor is a total game changer in the industry, and here's why. Professional top-tier money managers trading the markets are statistically right about their initial bias about when and where the market's going. That's going to be between 50 to 60% of the time on average, maybe 70%, but we want to focus on consistency here. Now, the normal experience for most is that they may be right about the market, but at the wrong time, and therefore one of two things will occur generally. A, the market goes against their position and they hold it until it becomes too painful and they finally capitulate and stop out and to close their position with a loss. Though many times things will eventually work out within some zone that they can stomach, and that unfortunately breeds the idea that this is just the nature of the beast, and that keeps them going for the time being, but that ultimately sets up a person for an eventual catastrophe through a significant correction, sometime in the future, as that only works until the market has a sudden turn that doesn't recover within their developed comfort zone, right? The other scenario would be the market goes against them and they hold and wait for the market to come back at some point in the future, no matter how long that may take. Now, there are some who have learned to properly hedge in the market, so they minimize their downside and the risk that has a of course has a cost to it as well, but it doesn't provide the kind of results that are possible when you just avoid all of that uncertainty to begin with.
Plus, it's uncomfortable and mentally painful and exhausting to sit in a market that's just waffling back and forth, that's not making you any money, or even worse, is taking money away from you as you wait for the market to turn around. Again, you're guessing and hoping that it's going to turn, and you may have a very powerful statistical edge working in your favor that it will turn, but that doesn't necessarily mean that it's going to happen right now. And again, if you could avoid all that pain and suffering, and instead just get in when the odds are flipping into your favor, it's just a much more pleasant and low stress experience.
Yeah. Plus, you're not paralyzing yourself and your capital throughout that time where you basically can't look at anything else that might be a better situation or scenario for you, right? That capital is just tied up and you can't redeploy it. Now, the bottom line here is that both scenarios are inefficient, they're stressful, and they're no longer necessary with what we're about to show you, especially if meaningful performance is important to you, but only if it's consistent and stable for a significantly more confident and reliable experience in the markets. Now, with this approach, you won't only be making money by taking mostly winners, but you'll actually keep much more of what you make. And you certainly won't have to endure holding on to losing positions hoping they'll come back for you. This sets you up to be able to literally double your current ROI with half the effort and time. This is how you achieve your ideal ROI with consistency and confidence, which has not been available before this innovation. So what does all this mean from a practical perspective, and how does it actually play out? So let's take a look on the charts. And there we go. Bo, you want to go ahead and go through this bar by bar for us?
Yeah, okay. So this is a 240-minute chart of Apple. A lot of people are either invested in Apple or they follow Apple. It's one of the sort of marquee stocks of our generation here. Obviously, if you haven't looked at stock charts before, you can see the bars here. The bars are just an arbitrary way for us to chunk what is essentially a continuous stream of price data into observations that we can then measure, analyze, and derive some actionable intelligence from. So each one of these bars comprises 240 minutes of trading time. And you can see very, very quickly and easily that the market essentially was going up during this time. Can you scale that down just a hair so we can kind of see a little bit of the longer term view? Now you'll see as the market rallied, went to the upside, it really breeds a decision point. At this point, do you want to continue to buy it? It's gone up so long, so far. it's probably logical that it's going to have a little bit of a correction, that the market's going to turn over. So if you currently would own Apple, you'd probably want to get out, take some profits, and be interested in getting in at a better price in the future. But there's another thing that you can do, which is very useful tool, which is to short a stock. And this is also something you can do in many other markets as well. So it allows you to become price agnostic. If the market goes up and you can predict it, you can make money. If you believe that the market's going to go down and you can predict it, you can make the same amount of money going in the opposite direction. So it's an important concept. If it's not one that's familiar to you, it's kind of outside the scope of this training to walk through how that works. But suffice it to say that you can just simply push a button to make money when the market goes up, push a different button to make money when the market goes down. So you can see in the area that's shaded red and with the number one, that's a logical area for the market to reverse. There are a couple of horizontal lines there, which are resistance zones that could cause the market to reverse. So it was very logical that the market would be in an area in which a reversal was possible at that point. But again, that leads us to the earlier scenarios. Do you just sell your shares or go short at that point and wait for the eventual turn? Or do you get more information and get more precise? So if we look now at the bottom of our screen, this is one of the breakthrough tools that we use. It's really the cornerstone of predictive failure technology, and that is a power indicator. Now, this is a proprietary indicator that takes a bunch of different aspects of price data and turns it into a simple, intuitive, and easy to understand indication of power, sentiment, passion, whatever word you'd care to use. And you can see very quickly and intuitively how, as the market rallied, uh, even though prices were going higher, the power really was not showing confirmation there. That tells you that the energy is coming out of the market and that a reversal is likely.
Quick interjection here, Bo. This also, we're showing a very simplistic perspective and view of what our overall analysis encompasses. So we're looking at one time frame, one chart here. There's a whole host of indicators and some analysis and filtration that we go through. But for the sake of keeping it simple, we're really kind of oversimplifying things for you just to kind of make the point and bring the concept across that we've talked about today. So understand that there's a lot more that goes on in the analysis outside of just looking at this time frame. There's multiple time frames that we look at. There's other variables and factors that we assess and we analyze and filter. So, but we just want to make the point here about how you identify a scenario in which the market is likely going to be moving in your favor, where the odds are strongly in your favor, versus when they're not. Okay, and that's a critical concept. And lastly, I know some questions have come in through various clients who've come with 10, 15, 20 years of experience in the market, and they feel they're very successful with their particular strategy or edge, and that they win the vast majority of the time. Great. And what we discover, though, in our sessions is, though they come in and the end result is that they win most of the time, throughout that, they're often giving back much of what they've come in with through drawdowns, through corrections, through time in the market in which you're having to hedge and basically try to make up for a position that's going against you. So there's a cost to that, and they're kind of building through. It's a very inefficient process. So again, two things occur. One, you're kind of holding on a bunch of stress and hoping and waiting for that market to turn around. No matter how confident you are that it's going to turn around eventually, think of all that time that you're losing that you can't redeploy that capital somewhere else where you can use it and have it work for you and make money. But also, there's there's also another factor in which many times you get in, you feel like for the sake of not missing a move, you'd rather just hold on, build the position, keep kind of adding to that, pyramiding until you get to that peak in the market where it finally does turn around. Again, all of that extremely inefficient way to grow your money, and it's stressful. It's a lot more work. Again, we're going to show you here how that can be dramatically reduced, if not eliminated, by understanding how to interpret when the most likely turning point in the market is going to likely be. And the idea that you're going to miss a move, you're going to find out that over the long run, the law of averages kicks in, and you're going to find that by having the odds statistically on your side, so that your effective win rate and effective accuracy is going to be significantly higher, but you're sitting through a lot less movement that's against you, going sideways, not going anywhere. Even if you miss some of those moves, in which you will, and it's okay because they weren't statistically in your favor, you will more than make up for it on the back end by just being consistently involved in the market where the odds are in your favor. And what you're going to find is by doing that, you're really going to be surprised at your output, which will very often we see a doubling effect. And it's difficult to wrap your mind around at first until you start to experience it. And that's again the purpose for why we want to show you in real time, live in front of a real audience for the month of December, what we do, why we do it, and give you that firm understanding through actual experience in doing it. Okay, Bo, go ahead.
So what's fascinating is we can see the little peaks in power there getting smaller and smaller. And then actually, if you just highlight this moment here, we had a rally up. This was what eventually was the peak in the market on a little bit higher power than before. That shows a new energy surge coming into the market. Now, notice this big red bar here. That was a point at which a lot of people were taking action and exiting that market. That was a quick sharp downdraft to the downside. And what's ironic is, had you gone short at that point, eventually the market did turn and it would have made you some money. But look at all of this back and forth. The market came back up. In this case, it didn't break to a new high, but there's no reason why it couldn't have, thus causing a stop loss for many trading styles. And the real goal is, how do we identify the real turning point so we don't have to sit through all that mess and muddle? Okay? That power indication right there, you can see again, without getting into all the details, it's bigger than the previous one. There's been a refresh in power. New energy is coming into the market. Well, would you want to go short when it's essentially like sitting behind a dump truck. You hear it revving its engine. It's pretty logical that there's going to be, some forward movement. Would you want to go short at that point? Under our predictive failure technology envelope, no. That refresh tells us that there's going to be at least one more bullish attempt to break the market out to the upside. In fact, that's such a clear indication that if you were an intraday trader, there was some long potential. You could have actually bought the market right here where the arrow is in the number 2 for an intraday trade or a scalp trade and make some money back to the upside as that test occurs. So what I really want you to focus on now is the teal envelope there and the number 3, because that's at the point where the next potential decision point occurred. So the market moved up. Obviously, you wouldn't be shorting it there. The market showed some signs of weakness here at the number 3. And let's go down directly below that to our power indicator and see what was different that time. So the previous potential reversal, again, there's really nothing special about that reversal. If you're a pattern trader, there would maybe have been a pattern there you could find on an intraday level. The setup is irrelevant. What's important is our ability to filter setups, to filter different strategies objectively with these measurement tools. Look at the difference in power on the second opportunity. Much, much lower. It had transitioned below the midline, which is kind of the neutral level, and it was expanding to the downside. Well, wouldn't you have felt a lot more confident with that information to go short at area 3 and then look at the experience that you would have had? Very short holding period before the real selling began, and the power now is greatly expanded to the downside. It's very likely that this market will continue lower over time. So you see the actionable intelligence that being able to measure power and to be able to see some of these cycles offers you. And this is a very, very consistent experience. I'll just talk about myself and my personal trading. Very often when I'm trading the S&P intraday, as you're going to see me do over the next month as we do these live sessions together, you're going to see 2 to 4 false signals before the signal that is filtered in as the highest odds. So functionally, what does that mean? For a quick example, here is a potential reversal and one that would have been filtered out. Here is a potential reversal, one that would have been filtered out. Here is another potential reversal, one that was filtered out. And it was actually the 5th potential reversal in this little example that had the filter that gave you the go-ahead to take that trade and showed you that the odds were best in your favor. And that's really what I want you to focus on, especially if you join us for some of these live sessions. Look at how many very valid very normal signals, both to the long and the short side, that we experience before we have the predictive failure technology confirmation to allow us to actually take risk in the market and put on a trade. You're going to see that over and over again. It's astonishing, and really I can't do justice with words or with simple static pictures. You're going to have to really live through that arc with us in a live market session to see the impact, to see the false setups, to see them tease you and try to seduce you into taking action. And we'll avoid those false signals. You'll see them set up, then you'll see them fail, and eventually we'll get it in at a much better price with a much simpler and less stressful hold. And also, something to highlight here, it's very logical if somebody was building a position to the short side, selling into rallies and beginning to take a position that would hopefully make money when the market eventually reverses. The risk envelope on that is quite wide. So if you look at this example here, you've got this little box, number one, that we have represented. Look at how much less risk you had to assume by waiting until the market really put the odds in your favor. You can be much more precise, which means that you need to take a lot less risk in the market, which then increases your reward potential in terms of actual money captured if that particular scenario does unfold as you hoped it would. But just visually, look at the difference here. You're taking a very nebulous, open risk, and here it's very tight, very controlled, and very compact. And yet, ironically, the profit objective for either of these trades would be the same. It would be the same sorts of support levels that you would identify for your logical profit objectives, no matter what entry skill you used in order to take that trade. Roger?
What we're focusing on here is efficiency and effectiveness. There's no reason to tie up your capital and tie up your time and undergo stress in a market that's inefficiently set up, in a market that's really not conducive to moving in your favor. So again, remember, just the mentality shift that I want you to focus on is we're not going to look at opportunities that are likely to make you money. Right? We're going to look at opportunities that are not likely to lose you money. We want to shift ourselves from the gambler going in and hoping to make a good chance profit in the casino because they've spent their time doing a lot of study and research and
From a mathematical, statistical background.
exactly, and strategies and techniques and these things that can help give them a better odds perspective where they can have a better chance at winning, but essentially at the end of the day they're still gambling, right? Mm-hmm.
It's really important to note that we're not maligning other trading styles. These statistical edges are very powerful and can produce consistent profits long term. But what we're saying is, why would you take more losing trades out of every given 100 trades that are offered to you by your particular strategy if you had a tool that would allow you to avoid a significant number of those losses? This is a layer of analysis which sits on top of many traditional market analysis tools and allows you to very objectively value which opportunity is the one that you want to be participating in.
And what you're going to do here is have this layer be able to filter out the least efficient and least effective times for you to be engaged in the market. So you see what's happening here is you're shifting yourself into having a perspective on the market where you're always working where the odds are highest in your favor and away and out of the market when the odds are not, or they're so-so, or 50-50 or 60-40. You see, so you want to produce a statistical advantage in your effective overall outcome, and that way you're making very deliberate profits, and you're going to be much happier when you're working in that arena, in that kind of environment. So at this point, we just wanted to kind of set the stage for you, give you a little bit of a taste of what you're going to be experiencing live, give you the concepts, what we do and why we do them, and you're going to see them in action live in real time Tuesdays, Wednesdays, Thursdays throughout the month of December. We hope you join us, and we hope it'll be a very eye-opening and mind-expanding time for you. And we believe that it's going to become a springboard to a much better outcome and result for you in the coming year 2015 and beyond.
Yeah, and so you'll find a link below this video in which you can go and register. We only have 100 seats available for this, so make sure you get registered quickly. And if you join the room for some reason and find out that the seats are full, just try back a little bit later or sign in for the next session a little earlier. We will be recording these, both a raw file, which will comprise the whole experience through all the different hours. And then we'll also have like a little digested version where we have the applicable moments where we're actually taking a trade. Because normally, when I trade the S&P, there are 1 to 2 trades in any given day. So there's a lot of downtime when you're being filtered out of the market that you can go off and do other things with your day, and then come back when the market's more conducive for a profitable setup. So that's the way we're going to go ahead and do this. Number one, we want to keep the raw data available for people so they can kind of see in real time, if you want, the rhythm of what a trading day looks like. And then also just as a bit of a track record so people can really see that we're doing this in the real markets, in real time as it happens. So if you can't join us live for some reason, please do sign up, and we'll send those videos off as they go through the production cycle and become available.
Yeah, absolutely. What we seek to give you is a shift in perspective, because perspective changes everything, so long as that perspective is within the proper context. So we're going to give you that context. We're going to give you a perspective that's going to be fresh, and I think it's going to be very liberating for you once you experience it for yourself live. So we do hope you join us. We'll see you starting tomorrow, actually, Bo, right? Yeah, tomorrow's going to be our first day, December 2nd, Tuesday. We'll see you then.
Yep. We'll be there bright-eyed and bushy-tailed. Hope you can join us.
Thanks, everybody.